Okay, good afternoon and welcome back everyone to our part two of our options education series. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we're here to talk about how to utilize leverage using options, but do so in a way with limited risk. And I do apologize for the late start here. I know what was communicated was a 4 p.m. start. I had a mix up of, I thought we were starting at 4:15, and I, again, apologize for the late start. But today we're here to talk about how to utilize options for leverage. That's one of the reasons why many investors such as yourself are attracted to using options. You want to be able to limit your losses if you're wrong, but leverage your capital if you're right. Because leverage, we think of it as a double-edged sword. It can really work in your favor if you get the directional view right, but what if you get the directional view wrong? How do you, the amount of risk that you're taking is fairly sizable. So options give you what we call optionality or convexity, the ability to have limited losses if you're wrong, but leverage your capital here to the right side. But there are some catches, if you will, to that. So we want to make sure everyone understands what the catch is and what are the things you could potentially do to kind of alleviate some of those catches, if you will, to this what's seemingly great strategy. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off by taking a look at just breaking down the difference between trading stocks and versus trading options. And the reason that we want to do this is because some of you may be brand new to options trading. I just want to make sure that we have a comparison that you are familiar with before we launch into utilizing options and the leverage that you get. And then what we're going to do is we're going to discuss two basic strategies, buying calls and buying puts. Basically, these are the two basic strategies that give you this leverage factor, but do so in a way at a limited loss perspective. So we want to talk about the benefits of buying calls and puts and some of the limitations or challenges that you have when you're buying a call or a put. Then we're going to talk about slightly more advanced strategy, a debit vertical spread. Because what this debit vertical spread is going to be able to do is give you is going to reduce your risk even further than buying a call or a put, and can actually enhance your potential returns. Then we'll talk a little bit about these spread trades, the optimal spread trades, and the trade management of these strategies. So how do you select expiration dates and strike prices? How do you manage them? And then we'll try to go through a few examples. I think the best way to learn always is to go through real examples, and then we'll open this up for Q&A here at the very end after we go through those examples. But the primary question that I want to help investors walk away from today's session is a clear understanding as to how options can provide leverage, but do so with limited risk at the same time. Okay, so my name is Tony Zhang. I'm the chief strategist here at Options Play, and today I hope to show you the power and also limitations of options, just so you think of them, just so you understand both the potential reward, but also the risks involved. It's very important that you understand what the risks are before you place a real trade. And for those of you that are just learning how to trade options, a great way to get some exposure to some of these strategies using real examples is to follow me every single Friday at 5:30 p.m. on CNBC on a show called Options Action. This is a show where every single week, me, Mike, and Carter, the three hosts of the show, we break down three examples, three trades for you, a specific stock or ETF, whether we're bullish or bearish on that ETF using a technical and fundamental thesis. And most importantly, we show you what option strategy we would deploy for that directional view. And you're going to be able to see a variety of different option strategies, and we're going to try to explain to you why we use certain strategies for certain market outlooks and certain outcomes. And this is a great way to gain exposure to real life examples of how strategists like myself would apply an option strategy to the real markets. So I hope to see some of you there on that particular show. So let's first start off by talking a little bit about stock trading. And if everyone can bring up your chat window at the bottom of your screen, please type 1 into the chat window if you currently trade stocks in your portfolio. And please type 2 into the chat window if you trade options as well in your portfolio. So 1 if you trade stocks, 2 if you also trade options as well. Okay, so I see a lot of 1s, meaning a lot of you trade stocks, and it seems like quite a few also trade options here as well. Okay, so when we refer to stock trading, This is the easiest, I would say, from a risk perspective to understand, because this is what you have. You have two potential options when you're trading stocks. You can either buy the stock when you're bullish, or you can short sell the stock if you're bearish. And the easy part about stock trading to understand is the fact that you have immediate gains if the direction is correct. What that means is that if you buy a stock and the stock even moves a single penny in your favor, you start to make money. If it moves a single penny against you, you start to lose money. And the amount of money you make is directionally proportionate to how much the stock moves up by. The further the stock moves up by, the more money you make. The further the stock moves down by, the more money you lose. This is what we call symmetrical exposure. It's very easy to understand your potential risks and rewards depending on where you think the stock is going to go. And stock trading, you can really trade on any time horizon. Whether you think the stock is going to move higher over the next day, the next week, the next month, the next year, you can hold on to a trade for as long as you want. There's no limit as to how long you are holding onto the trade for. The only limitation that you have with stock trading is that there are no neutral options, meaning if you think the stock is going to roughly trade sideways and you don't think it's really going to move very much, there's really no way for you to make money from that trading in a stock. You can only make money from that trading an option. So we're going to explore some of these things as to how you can utilize options to take advantage of different outcomes. So the first strategy we're going to talk about is buying a call option. Some of you may be familiar with this. Many of you may have traded these strategies, but for those of you that are brand new, we're going to walk you through the strategy. Or more importantly, not only are we going to talk to you about the advantages, we're also going to talk about some of the disadvantages that you have with buying a call option. So buying a call option is what we call a limited risk, unlimited reward strategy. What do I mean by that? If you buy a call option, you have potentially unlimited potential reward. In exchange, if you're wrong on the trade, you have limited loss potential. So let's look at this example. I have stock XYZ trading at $100. Let's say I think the stock is going to rally. I think it's going to rise in value going forward. So let's say I buy a $100 call option and I pay $4 for this call option. Now, some investors will say call options are bullish, and generally that's true. However, I think that just calling it bullish is not accurate enough. A much more accurate view or much more accurate description of a call option is that it's bullish by a certain amount. And that certain amount we're going to come back to is how much you pay for the option. So just to understand, if you buy a $100 call option, what you get is unlimited gains to the upside, similar to buying a stock, right? When you buy a stock, there's no limit as to how high the stock can go. The further the stock goes, the more money you make. That's exactly what you get with a call option. But with a stock, if the stock keeps going lower and lower and lower, you lose more and more money. A call option protects you from that because whatever you pay for the call option, in this particular case, I'm paying $4 for this $100 call option. That's the most I can lose. No matter what happens, even if the stock goes to zero, I can only lose $4 a share. But if stock keeps going higher and higher and higher, I make more and more money. Now, this sounds like a pretty good deal, right? Who doesn't want to have limited losses to the downside with unlimited gains to the upside? And largely, I think this is what attracts a lot of investors to trading options, this limited risk, unlimited reward risk profile that you get. However, there are some challenges with this. It's not as simple as that, or it's not as easy as that, because in order for a call option just to be profitable, not only do you have to be bullish on the stock has to exceed the break-even price of the option of the stock has to exceed the break-even price of the option strategy before you're even profitable. And what that means is that you can actually get the directional view right and actually still lose money on the trade. So maybe the stock doesn't go from 100 to 104, maybe it goes from 100 to 102. So you got the direction right, but because the stock didn't move far enough, you actually lost money on the trade. If anyone has experienced this, bought a call option, the stock went in the direction that you expected to, and then you still lost money on the trade. If you've experienced this, please type yes into the chat window. And I'm gonna bet I'm gonna see a lot of yeses. People who have bought a call option, the stock went in your favor, and then you lost money on the trade. So I see a lot of yeses coming through the screens. And this comes down to the fact that just buying a call option when you're bullish is not a good idea. You have to understand what the break-even price of the call option is, because you have to overcome the cost of the call before you make any money. So you have to take the $4 that you pay, add it to the strike price, and that is your break-even point. And you have to have the stock exceed the break-even point before you make money. If it doesn't exceed the break-even point, you actually lose money. Even if the stock stays where it is, stays at $100, what happens is you lose the $4 that you've paid for that call option. So that's why I say a call option is not just bullish, it's bullish by a certain amount. And that certain amount is dictated by how much you pay for that call option. Some call options are expensive, some call options are cheap. You have to figure out what the break-even price of your option is before you can decide, should I buy this call option? That is the biggest lesson that investors need to learn before they buy a call option. Does that make sense? Please type 3 into the chat window if that makes sense to you. And the break even of a call option is simply the price that you pay plus the strike price. So $4 that you pay for the call option plus the strike price, that's how you get your break-even price. You have to believe the stock is going to not only reach that price, you have to believe it's going to exceed that price. So you have to believe the stock is going to go to 105, 106, 107, 108 before it makes sense for you to buy that call option. So if, let's say, the stock goes from 100 to 110, how much money do you make on the call option? How much money do you make on the call option if the stock goes from 100 to 110? If anyone knows the answer to that question, please type the answer into the question. And I see a few correct answers, and that's $6. Basically, what you're doing is you're making the 100 to 110, which is $10 in potential returns. And then what you have to do is subtract the $4 that you've paid for the option, and that's how you get your total profit here of $6. So in this particular case, what you've done here is this: if the stock goes from 100 to 110, you've effectively risked $4 to make $6. Now, what is that? That's a return of 150% return on your capital, okay? So if the stock goes from 100 to 110, normally if you bought the stock, that's a 10% return, right? If you go from 100 to 110. But if you traded the option, your $4 return, your $4 risk netted you a $6 profit, which is 150% return. That is the embedded leverage factor that you're getting when you're trading an option. You're leveraging your capital. You're risking smaller amounts of capital, and you're leveraging your capital. Does that make sense? Please type 2 into the chat window if that makes sense to you. But the biggest challenge here is that you can't just buy a call option if you're bullish. You have to only buy it when you believe the stock is going to make a substantial move here to the upside. And many, many times you're going to find the stock is going to move 103, 104, 105. And what you realize is that you're either not profitable, barely profitable, or just breaking even at that point. So buying a call option just because you're bullish is not good enough. You have to believe the stock is going to make a big move to the upside before it makes sense for you to buy that call option, okay? So that's the challenge. That's the biggest lesson that you have to learn with call options, and that's the biggest challenge that you have with call options. So what I'm going to teach you is a more advanced strategy that helps offset some of this. It makes the returns, risks a little less, and potentially gives you a higher return. And this is what we call a debit spread. So this is really where we start to combine buying and selling options together to try to maximize the potential outcome of a scenario. So I'm going to lay out the exact same scenario. Stock is trading at $100. I think the stock is going to go to, let's say, 110, right? I think the stock is going to rally. So if I bought the stock, I'm looking at a 10% return. How can I maximize return by utilizing options? So what I'm going to do is I'm still going to buy the $100 call option as I did in the previous example, and I'm still going to pay $4 for that call option. But remember, when you're buying a call option, what you're effectively paying for is unlimited upside. But when you're trading an option, you have an expiration date. So you have a time frame as to when you think the stock is going to reach that specific price. And plus, in this particular case, I have a price target. I think the stock is going to reach about 110. Maybe you're using some technical analysis, maybe you're using some fundamental analysis, but you have a price target in mind. You certainly don't think the stock is going to reach 300 in the next couple of months, right? You have some idea as far as where you think the stock's going to go. So what you can do is you can basically say, well, as much as I like unlimited upside, if I don't think it's going to reach there, why should I pay for it? And the answer is when you're trading options, you don't have to. You can actually sell the 110 call against it and collect some premium. So what you're effectively doing is you're selling away any upside above 110. You're basically saying, I'm okay not participating on any upside above 110. And in exchange for that, I'm going to take in $1, right? So I pay $4 for the $100 call option, and then I sell the 110 call for $1. And what this does is it caps the upside potential that you have on this particular strategy beyond 110. So if the stock goes above 110, you're not participating on it, but in exchange, you got paid $1 for it. So what now how it happens is that instead of paying $4 for this bullish strategy, you're paying $4 minus $1 that you're collecting. So your total risk now is reduced from $4 a share now down to $3 a share. So your max risk of the downside is even limited further to $3 a share. So what you've done is you've given away some upside in exchange for lowering your risk or lowering the amount of capital that you need to get into this trade. And this has two effects. One, it reduces your risk. But two, now your break-even price is lower because now your break-even price is $3 plus the $100 that you paid for. So now, instead of having the stock to reach 104 before you're profitable, as long as it reaches 103 or higher, you're going to be profitable. Now, a lot of investors will say that doesn't sound like a big difference, right? Moving from 104 to 103. Well, let's take a look at what the results are if this stock moves up to the 110 target level that we talked about here before. Now, remember, in the previous example, we risked $4 to make 6, which is 150% return on my capital because I risked $4 to make 6. Now, in this particular example, if the stock goes from 100 to 110, how much money can I make on this particular trade if the stock goes from 100 to 110? Or even if it exceeds 110, let's say it reaches 112, how much money do I make on this particular trade? If anyone has the answer, please type it into the chat window. And Susan's the first to answer that correctly. It's $7, right? So what I've done is I basically, whoops, I apologize. I should not have done that. But before I risked 4 to make 6. Now what I'm risking is 3 to make 7. That doesn't sound like a big difference, but as you can see before, that's 150% return on my capital. But when I'm able to risk 3 to make 7, that turns into a 233% return on my capital. So for the exact same outcome from the stock going from 100 to 110, if I bought the stock, I'm looking at a 10% return. If I'm looking at just buying a call option, I'm looking at 150% return. If I'm looking at a call spread, I'm looking at 233% return. And remember, what happens if the stock declines down to $90? How much do I lose? If I bought the stock, I would lose $10 a share. If I bought the call option, I would lose $4 per share. If I buy this call spread, I would only lose $3 per share. So not only in the debit spread do you risk the smallest amount of capital, you also have potentially the highest return if you do get the directional view right. And what you've done is you've lowered your break-even point. The stock doesn't have to move as far before you are profitable on that trade. So those are the benefits that you start to see as you trade one of these more complex strategies. Now, these complex strategies, if this is your first time, I'm sure it's confusing to understand. That's okay. That's why we record these sessions so that you can come back and review these. And we're going to go through some real examples using real stocks, but I tend to find that these XYZ examples using whole numbers are easier for people to wrap their head around, especially especially if you're coming back and reviewing this for the first time. But we're going to look at some real examples to help solidify this. But the goal here is to reduce your overall risk down to just a few percentage points of the underlying stock's value, increase your potential returns if you do get the directional view right, and improve your probability of success on these trades, okay? So first of all, what we've done is we've covered a call option and a call spread. These are bullish strategies. I'm not going to spend as much time on bearish strategies, puts and put spreads, because these are basically complete mirror images of what I just explained to you. So instead, what I'm going to do is I'm going to look at options play, which is a tool that you all have access to free of charge on your First Trade account. You can access it by going to your home screen and clicking on the options wizard button here on the lower left-hand corner. You can also access it through your options chain. When you go to your options chain, there's a link here for the options wizard. So there's quite a few different ways that you can access the options play wizard. You can also go to trading options, and you'll be able to see the options wizard screen here on your options order entry page. So anywhere that you basically have access to options, you'll be able to access the options wizard. This is the options play platform that is embedded into the First Trade platform that's actually going to help automate a lot of the things that I have shown you here today. So we built this platform to help automate all the things that I just taught you. And I haven't even spent the time to talk you through how to find expiration dates, how to choose strike prices. We're going to come back to that, but the platform automates what I'm going to teach you next. So for any stock that you type in, well, first of all, the platform is divided into three sections. You have trade ideas on the left-hand side, you have your security analysis panel here in the middle, and you have trading and income here on the right-hand side. Last week, 2 weeks ago, we covered the income tab for those of you that generate income using options. Today, we're going to cover the trading tab for those of you that like to speculate on the directional views. So those are some of the things we're going to discuss here today, is looking at the trading tab. And this platform allows you to type in any symbol, and you can, using the technical analysis on the specific symbol, gain a directional view. Whether you're looking at this chart and you say, I'm bullish, we'll show you 3 bullish strategies, or you can select I'm bearish, and we'll show you 3 bearish strategies. So this way, you can type in any stock and put in any directional view, and we will show you the strategies based on your directional view. So let's look at NEO, for example. And again, these are just examples. These are not by any means a recommendation or a suggestion that these are bullish stocks and that you should trade them. I'm only using these as examples for educational purposes. So let's say I have a bullish view on NEO, and the stock is recently pulling back to a support level, and maybe you think the stock is going to bounce higher. You think it's going to continue to rally back to its 52-week high around $55 or so. So the 3 bullish strategies that we'll default to is buying 100 shares of the stock, buying a call option, which is the simple call strategy that we talked about first, and then the vertical spread, which is the debit spread that I talked about second. So as you can see, to buy 100 shares of the stock, it would cost you $4,600. To buy a call option, $555. Buying a call spread, $430. So just to put this in percentage terms, 555 out of 4,600 is about 12-13%. 430 out of 4,600 is roughly 8% and 9% or so. So the call option is risking about 12 to 13% of the stock's value. The call spread is risking about 8 to 9% of the stock's value. So let's look at how these strategies perform. And the best tool you have at your disposal is the P&L simulator. Because the P&L simulator allows you to assume, what if the stock goes higher? What if the stock goes sideways? What happens if the stock drops? And how does each strategy perform side by side? And I always encourage investors, before you look at how much money you can make on a strategy, always first look at how much can you lose on a strategy. And first ask yourself, am I comfortable with that? Because if the answer to the question is that I'm not comfortable with these losses, if this trade didn't go in my favor, you should move on to the next trade. You should not look at this trade any further. Don't tempt yourself with potential reward if you're not first comfortable with the risk. Always make sure that you understand the risk and that you're comfortable with the risk. So let's just say my directional view that NEO is going to rally back up to its $55 all-time high is wrong, and the stock declines back down to $30. That's always possible, and you always should account for that. So what you can use is the P&L simulator and say, what happens if the stock declines down to $32, which is the low that we saw here back here in May or so. So if the stock declines to $32, well, if I had bought the stock, I would be looking at about a $1,400 loss on that particular trade. If I bought the call option, I'm looking at a $550 loss. If I bought the call spread, I'm looking at a $430 loss. So before you trade any strategy, first ask yourself, if I lost $555, am I okay with that? Do I have enough capital in my account to make my next trade? Or is that going to blow such a big hole in my portfolio that I'm not going to have enough money to place another trade? If the answer is the latter one, don't trade this. Only if you say, okay, even if I lose $500 or $400, I'm okay. I can continue trading. I have enough capital. Then proceed with what you can potentially make. Okay, that's my first piece of advice. And you can use our risk and investment calculator as well. You can actually choose to say, I'm willing to risk up to $2,500, and our platform will actually calculate for you the appropriate number of contracts. You can buy 4 contracts of this, 5 contracts of that, 129 shares of the stock. It does the automatic calculation for you so that you can compare apples to apples on this particular strategy. And then what you can do is then start taking a look at, well, what if I'm right? If I'm comfortable with the risk, well, what if I am right? What if it does go up to 55? How much do I have to gain on this particular trade? If I bought the stock, I'm looking at a 17% return on my capital. That looks pretty good, right? 17% return in a couple of months is not bad. But if you look at the call option, I'm looking at about an 80% return on my capital. That's a leverage factor of about 5 to 1, right? I'm getting 5x the return on my trade. That's a leverage factor that we're referring to. And then if I traded the vertical spread here on the right-hand side, I'm looking at 132% return. And this all comes down to the fact that you're risking less capital for the particular trade. And this one, I'm able to buy 5 contracts. In this one, I'm only able to buy 4 contracts. So that's how I'm able to get a higher dollar amount and a higher percentage return on my trades. So this vertical spread, even if you're brand new to options trading, the point of our platform is so that even if you're brand new, you have the tools to help you explore and analyze these trades so that you can learn to trade these more complex strategies that can provide some benefits in terms of lowering risk and potentially giving you a better return on your trades. So hopefully this gives you a better sense for how you can utilize these strategies for your portfolio. And you can type in any symbol. Let's look at, it doesn't really matter what symbol we're looking at, right? Let's say I want to take a contrarian view to a healthcare stock. Maybe, I'm looking at the fundamentals. It just doesn't make sense to me. I think the stock is bearish. So let's look at a bearish trade. And again, these are just for educational purposes. These are examples. These are not actual recommendations or suggestions to trade this. But let's say I think that a stock like AbbVie is topped out. I think that it's failed to break out to new all-time highs, and I think the stock is headed back towards 110. So what can I do? To short the stock, that's certainly one option, but I don't recommend it. You guys have all seen what has happened to short sellers with GameStop, with some of the other stocks. They have absolutely been killed because they have unlimited risk. So don't short a stock. In my opinion, I don't think it makes sense for most retail traders to short a stock because truly your risk is unlimited. Instead, look at buying a put option. Put option gives you limited risk. Here I'm only limited to $565 of risk, or look at a put spread, which reduces my risk even further down to $477. On a $116 stock, $565 is roughly a little over 5% of the stock. 477, what's that? About 4% of the stock. That's all I'm risking. Even if the stock goes to 1,000, let's say this becomes the target of Reddit again, and all of a sudden the stock shoots up from $116 to $400. Well, guess what? When you short the stock, you have unlimited risk. Here, you're risking a few $100s per contract on this particular trade. But again, always, when you're using the P&L simulator, look at your potential risk first. look at what if I'm wrong and the stock continues to move higher, right? The stock is on an uptrend. There's no doubt about that. So maybe this continues on its uptrend and it goes up to 130. Well, how much do I have to lose? If I shorted the stock, the further it goes, the more money I lose. But here I'm only risking $565 or $477. So first, always ask yourself, if I lost $500, $400, $500 on this trade, am I comfortable with that amount of risk? If you are, then proceed. If you're not, simply walk away from this trade, look at another one with less risk that you're more comfortable with. So if you are comfortable with this amount of risk, then you can say, okay, what if AbbVie gets back down to, let's say, 110 or so? How much profit do I have on this particular trade? If I shorted the stock, I'm looking at about a 6% return. If I bought the put option, I'm looking at about a 77% return. If I bought the call put spread, I'm looking at about 110% return. So this is how you can determine, is there enough potential reward for the risk that I'm taking? For example, for this one, perhaps not enough, right? You're making $435 in potential profits in exchange for $565 in risk. Maybe that's not the right risk to reward ratio, but making $523 while risking $477 might be a risk to reward ratio that you're more comfortable with. And that's what you get when you're able to utilize these more advanced strategies using options play, that even if you're brand new, you can start exploring, you can start learning and start getting more comfortable with these strategies before you execute them. And the best thing that we've built for first trade investors is that you can click on the trade button and hit on preview order, and it will pre-fill the order ticket for you within first trade, so that you have this order ticket already pre-filled for you. You can put in your price, your limit price that you want to enter the trade at, and click on preview order and have it sent for execution. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Okay. I'll go through one last example before we go back to the slides. I'll look at Moderna. It looks like a few people wanted to look at Moderna. This is, again, just for illustrative educational purposes. This is not a recommendation to short Moderna or look at bearish positions here on Moderna, but I do think it's an interesting example here of a stock that has gotten so overextended that a lot of investors think perhaps it's gone a little too far too fast. Maybe it's going to start to come down. How can I utilize options to play for this downside? Let's see. Okay, let's look at Moderna. I haven't looked at this stock here today, but looks like it's further up here around 321 today. Closed at 321, another big day. Well, yesterday was a big day, but it did end up close a little lower here today. It looks like it closed at the upper end of the range here from yesterday's close at about the same price that it opened yesterday. So it certainly looks like this momentum is starting to slow down here, right? And maybe some investors are trying to bet that this is going to come back to earth. So let's look at this. This is an expensive stock, $321. So first of all, expect that the options are going to be expensive, right? So here, as you can see, my risk on a single put contract is $3,775. So remember that the very volatile stocks like these are going to have very expensive options. That's the one thing that you cannot avoid. So but you have significantly less risk on these types of strategies than if you were to short the stock. A vertical spread here still risks $3,360. So let's take a look. First of all, I think there's, this stock is kind of unstoppable here at the moment. This stock could easily rally for 400 or so. So we always ask ourselves, what happens if the stock reaches $400 after you short the stock, after you look at some bearish positions? If you shorted the stock, you're looking at $8,000 loss, $3,700 loss, or $3,300 loss. Not for the faint of heart, right? This is really only for those of you that have account sizes over $100,000. Is it is this the type of trade that you may have the risk tolerance, if you will, to trade? If you have a $10,000 account, you should not be trading something that risks a third of your account on a single trade, okay? So only for those of you that have sizable accounts, but for those of you that do, this is a trade, perhaps, if you want to be very speculative. Be aware that you could easily lose $3,700 or $3,300. But if you are right, if the stock gets back down to, let's say, 220 or so, which is the price that it was trading at just a few weeks ago, right? Maybe it gets back down to reality. Because fundamentally, nothing has changed from 2 weeks ago. The only change is that it's being added to the S&P 500, which has no material changes to the company of its earnings or its profits or anything like that. So let's say the stock declines back down to 220, which is where it's trading at. And it has all the way through September to do this, right? That's 2 months from now. So let's say 2 months from now, the hype is died down, similar to what we saw in Tesla after it got added to the S&P 500. You saw all this hype and then eventually came all the way back, right? Back to where it was. So let's say you think it's going to come back down to 220. Well, if it did, if you shorted the stock, you do make a nice 31% return. If you bought the put option, as you can see, you make 191% return. And what's really interesting, and I'm glad we brought this example here, look at this put spread. It only made 167% return. Why is that the case? It's because a put spread or any vertical spread limits the max gain that you have. Because remember, here I bought the 330 put. So I have unlimited downside. As long as the stock keeps moving lower and lower and lower, I can make more and more money. If I bought the put spread, here I bought the 330 put, but then I sold the 240 put against it. So I bought the 330 put for the 37.75. That's the same price as this. But then I sold the 240 puts against it to collect $4.15. So in exchange for that, what I've done is I've collected an extra $4.15, and in exchange for that, I gave away any gains below $240. So if the stock reaches the 220 price target, I've basically given up any gains below 240, and that's why the vertical spread here actually has a smaller return than the put option, which has unlimited gains to the downside. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. And that's why we built these tools, because it's hard to figure these things out in your head. No one can figure these things out in your head. These tools are designed help you figure out what you can potentially make, what you can potentially lose. So that helps you make your decision as to which strategy do you want to trade. So if you believe the stock will go down to 220, maybe you're better off just buying the put option. This way, that makes your decision a lot easier, a lot simpler to understand, and you might want to click on the trade button, hit preview order, and send this off for execution here at First Trade. So we created these to try to make these processes as simple as possible for you so that you can truly understand what your potential risks and rewards are before you execute a trade. So with that, let's cover just what are optimal debit spreads and how to manage these trades. So generally speaking, going out 60 days to expiration is your ideal starting point. And what you want to buy is the at-the-money call or put and sell a 20 delta call or put against that. So let me just walk you through that. When you're using the options play wizard, it actually does all of the selections for you. But I will walk you through it just so you can understand. Let's go back to our NEO example for argument's sake, right? So NEO, we were looking at buying the 45-55 call spread on NEO, right? And the reason for that is because we're using the September 17th, which is 58 days from expiration. Here are all the different expirations that you can choose. The September 17th expiration is 58 days to expiration. So we're automatically selecting the expiration date for you. And then what we do is we select the strike prices also on your behalf. So like I said, we want to buy roughly about a 50 delta call or put, but we want to buy the first in the money call or put against that. So we're basically buying the first in the money call option, which is a $45 call option. And then what we want to do is we want to sell roughly a 20 delta call against that. So whether we choose the 55 or 60, these are kind of your two choices that are closest to 20 delta. We usually want to select the strike prices that are inside of one standard deviation, and that's why we've chosen the 55. So we've automated this work for you so that you don't have to manually go to an options chain, find the expiration, find the strike price, find everything. We automate this process for you so that you can just jump into the analysis part. You can make tweaks if you want, right? So for example, in the Moderna example, for those of you that are a little bit more experienced, you can do some adjustments. You can say, instead of selling the 240, I'll sell the 220 instead. That is going to allow you to take advantage of that full move to the downside down to 220 if you do, right? So here, now instead of making 190% return, I'm making a 206% return. But these are small adjustments you can make based on your outlook. So our platform allows you to have a great starting point and then make minor adjustments to it based on your particular outlook. But it gives you that starting point. And with these types of strategies, what you're going to find is that they have smaller percentage winners. We get a lot of questions from investors saying, how do you trade something with 40% winners? Well, the reality is that because your potential reward is greater than what you risk, you don't have to win 50% of the time to make money. You can win 40% of the time and still be profitable in the long run, because you might lose more often, but every time you win, you're winning significantly more than what you lose. So it's more about the longer term outcome rather than whether you win 40% of the time or win 60% of the time. It's really important that investors focus on profitability, not probability. Probability is only one half of the equation. If you focus just on probability, it's very likely that you're not focused enough on profitability, which is really what you should be focused on, okay? And then once you're in these trades, how do you manage them, okay? The rules for buying a call option or buying a debit spread are identical. They're actually fairly simple. There's only two possible triggers that generate a signal to exit the trade. You either exit at a loss of 50% of the premium that you've paid, or you exit at a profit at 75 to 100% of the premium that you've paid. So let's say you buy a call option or a debit spread for $3. What you want to do is basically say, once you've lost half of that, meaning if you pay something for $3 and it's now trading at $1.50, you've lost 50% of what you've paid. It's time to cut your losses and move on. Does that make sense? Please type 6 into the chat window if that makes sense to you. If you buy something for a certain value, you lose half of it, it's time to cut your losses. The reason for this is because whenever you have a call option or a debit spread that's already lost 50%, your chance of losing the other 50%, the rest of what you have left on the table, is usually about 80%. So yes, you can hold on to it to try for it to come back, but your chance of success on that is usually about 20% or so. So it's actually better that you keep that 50% and apply it to the next trade, rather than hope that in the 20% chance that you hopefully get back to break even, okay? Now, if let's say you pay $3 for something and it starts to increase in value to roughly $5.25 or $6, somewhere in this particular range, now it's time to take profits. Take your profits and run. Now, here's the thing, is that a lot of people ask me about why don't you roll your losers to try to turn it back into a winner? I'm not a big fan of that. I hate that philosophy of trying to prevent losers. Cut your losers. Learn to let go of losers, because you're going to have losers. There's nothing you can do to prevent that. But what you can do is turn your winners into much bigger winners by rolling your winners. So don't focus on rolling losers, focus on rolling your winners. Because if you get the directional view right on a winner, what you can do is you can basically close out your winning trade and reopen a brand new one and basically roll your profits into further profits onto the next trade, okay? So what I mean by that is, let's say I'm looking at this NEO trade, right? And I've bought let's just use a simple example. Let's say I bought the $45 call option and the trade goes exactly as I expected to, and the stock reaches $55 and I've made a $500 profit. Well, what I can do is I can basically take my $500 profits and then maybe buy another, maybe at that point, maybe I'll buy a November $55 call option. So now what I have is the ability to make even more profits if the stock keeps going further and without risking any additional capital, because I've effectively rolled the profits from my first trade to pay for the call option on my second trade. And if my second trade starts to be profitable, I'm effectively playing with house money. That's the rolls that you want to make, not the losers. Learn to let go of your losers, because losers means that you simply got it wrong. Let go of those. Understand that you're going to be wrong. If you can't accept the fact that you're wrong sometimes, that's going to be the death of a trader, is traders who cannot accept that they were wrong. Traders that are survive in the long run are the ones that they accept the fact that they can't be right all the time, and they cut their losers. They let go of small losers. And it's easy to let go of a small loser. It's much harder to let go of a large loser, because sometimes you have a losing trade, you roll it, you try to do something to fix it, and what you end up in is a bigger hole. And what happens when you end up in a bigger hole? That's the hardest ones to let go of, because now you feel that you've lost so much money that you can't let go of it. It's what poker players call pot committed. We just feel we've already lost so much money, we better just throw the kitchen sink at it to try to get our money back. And that's when you start making really terrible decisions. So whenever it comes to these trades, I always recommend the only rule that you really need to focus on is cutting your losses. If you can cut every single losing trade at 50% stop loss, guess what? You're never going to have any big losses. I get questions from investors all the time saying, hey, I made this bad trade and I have a really big loss. How do I come back from it? Well, the answer is there isn't a good way to come back from it. The best way to prevent that is to prevent that big loss to begin with. Cut your losers first. Cut your losers when they're small. That's how you advance in trading. And a lot of investors feel they feel like if they cut their losers, they never can potentially make money. And that is the biggest fallacy. And I hope that this helps those of you that are starting out, who are perhaps feeling that you're not able to find that consistency in trading. This is the one rule that I think that sets successful traders apart. It's not their strategy. It's not what indicators they use. It's not who they follow. It's how they cut their losses. Successful traders cut their losses very quickly, so they never are in a position where they ever have to say, hey, I have this really big losing trade, because they cut their losers before it ever gets there. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to how to get started with options trading and the mentality that you need to have to become successful in options trading. And just a reminder, First Trade has an iOS and Android platform that has a much improved, I would say, options trading experience. You have a redesigned options trade. You have the ability to enter complex option orders very easily on the Android and iOS platform. You have your risk to reward profile. So even if you're on the go, you can still do a lot of the analysis built into options play, and you can close your options, complex options positions with a single order. So this is really making it a lot easier, even if you're trading on the go with your Android platform. And just a quick reminder for those of you that are first-time users of options play, I host a weekly event every single Tuesday morning for everyone to attend. This is a market outlook session. We talk about the macro markets. I talk about my views at a high level from the equity markets, bond markets, commodity markets, and some of the economics that I'm currently following that inform my decisions. You can join us every single Tuesday morning at 8:30 a.m. And we also publish a weekly options newsletter. This is where you get bullish and bearish ideas, as well as our income reports. So I suggest that you sign up using that link on your screen. So with that, that covers what I wanted to share with you. I have a few minutes to answer some questions. So if you have any questions, you can type it into the Q&A section, and I'll try to answer as many questions as I have time for before I have to sign off. How are profits and losses on options taxed? So they're taxed just like your stocks. It's based on your holding period. If you're in a taxable account, they're taxed based on your holding period. So if you're holding them for less than 1 year, it's short-term capital gains. If you're holding them for longer than 1 year, it's long-term capital gains. The only exception to that are index options. So if you're trading index options like SPX, NDX, XND, these are taxed at, it's a 1256 contract. So 60% is automatically taxed at long-term capital gains, 40% at short-term capital gains. When you select the drop-down price, you always choose the minus 25 delta. Why is this the case? So puts have negative delta. Puts have negative delta because as the stock declines, you make money. As the stock rises, you lose money. So calls always have positive delta and puts always have negative delta. So if I'm looking at puts here, as you can see, these have positive deltas, but puts, as you can see, have negative deltas because it's a relationship, right? Puts make money as the stock drops. That's why you have a negative delta. Is there an easy way to roll a long call on the platform? So, this is really where you do have to close out an existing call and then open up a new call into 2 separate orders. How does exercising my options work? So Alec, you can call up first trade if you want to ever exercise a call option, but I will say, in my 10 plus years of trading options, I have never exercised an option, and I don't really see a good reason that anyone needs to exercise an option. So I'm curious as to hear why you think you want to exercise your option, but for the most part, retail traders should really never really have to exercise an option, in my opinion. Over a 60-day trade and it loses 50% at day 30, still 30 days to go. Are we willing to sell? Andrew, time does not matter. If you've lost 50% of the premium of the call or a put or a debit spread that you've paid, it's time to cut your losses. How do I compare options play scores? So the options play score is that balance between probability and risk to reward. It's looking at your potential profitability on that trade. So the higher the options play score, the better the risk to reward and the probability are balanced and skewed in your favor. If a stock price is above sell part of a call, I know you make full amount, but do you have to close out or would it automatically close out the buy and sell part of the spread? No, Jamie, you have to close out your trades. There's nothing really done there's nothing that's really done automatically for you. Anything that's done automatically for you, generally speaking, you don't want them to do it automatically for you. You always want to close out these trades prior to expiration, either at a profit or loss, but you want to close out your trades yourself before expiration. Gabriel, we actually recorded a session on how to close positions. So if you go to the link that I just sent you, as you can see in part 1, section 4, entering orders and managing positions. This is a recording that we recently recorded on exactly this. It shows you how to enter orders and how to close positions using both the desktop and mobile platform within First Trade. So please review that video. Any other questions? Gabriel, Lonnie, Andrew, you're very welcome. Andrea, you're welcome as well. In the software, is there a process to close a leg of the option so you become break even? I'm not sure what you mean by close a leg so that you become break even. You can close any trade at any time, regardless of whether you're profitable. I mean, you can close it based on what the market price is, right? So if you buy something at 100, think about it the same thing as a stock. You buy it at $100, now trading at 110, you can sell it at 110. You can only sell it for what the market is currently valuing the security at. So you can always close out any option prior to expiration. Whether you're profitable or not, that depends on what the market is valuing that security for. So you can always close any position that you have open. And if you want to review how to do that, I suggest that you look at part 1 of our Options 101 course, where we talked about entering option orders and managing positions. What would be a good strategy for options trader for a bigger size portfolio? Well, the size of your portfolio really doesn't differ based on the options strategy. You would just simply have more flexibility to trade larger size, and you have more flexibility to trade new symbols. So for example, Moderna risking $3,700, that's only suitable for someone with a larger account. Smaller accounts just simply don't have the flexibility to trade that. You just have more options, but the strategies remain exactly the same. Jamie, thank you so much. All of you that said thank you, I really appreciate it. Is GE going to split? If I'm not mistaken, GE is doing a reverse split. I don't think it's split just yet, but they are doing a reverse split. I think it's a 4-for-1 reverse split. 8-for-1. So they're going to basically be a stock that's 8 times higher. I've seen other options traders, when the option moves in their favor, they close one part of the leg, then remove the risk off their table. Free lunch trade maybe. So that's what we refer to rolling a trade, right? When I refer to rolling profitable trades, that's what we're referring to. I don't know specifically what strategy you're referring to, so it's hard for me to comment, but that sounds like what I'm referring to as far as rolling your profitable trades. Taking risks off the table and playing with house money, that's how you get ahead, not by trying to figure out how do you turn your small losers back into small winners. That's not how you get ahead in the long run. Cut your small losers. That's how you're going to be able to prevent big losers and then focus your attention on turning your small winners into much bigger winners. That's where you want to focus your attention on. Okay, that's all the time that I have here for today. I hope that this was helpful in giving you a better understanding for these option strategies, how to utilize the tools that are available to you here at First Trade, and I will see you here in 2 weeks' time on our next options education session. Thank you so much, and have a great trading day.